Hi, my name is Bonyet and welcome to Boring Money. This content today will only be general in nature, may not be right for your circumstances, and advise you seek your own professional advice. Today we're going to be talking about HECS or Higher Education Help Loan Debt. Now, HECS stands for Higher Education Contribution Scheme or HELP Higher Education Loan Program. Now, the HECS or HELP debt is a loan program provided by the Australian government to help students pay for higher education. Under this program, eligible students can borrow money from the government to pay for their university or other higher education fees. The borrowed amount is added to their HECS or HELP debt and must be repaid through the tax system once the student graduates and earns a certain income threshold. Now, people can check their debt balance through their ATO portal. Now, question is, when must you pay and how much? Now, repayments of HECS or HELP debt is income contingent, meaning that the repayments are based on the income of the borrower and are deducted automatically from their taxable income. The repayment rate is calculated as a percentage of the borrower's income, with higher earners repaying a larger percentage of the debt. Now, repayments begin at 1%. Once earnings reach $48,361 for the financial year 2023 and may increase up to 10% for earnings above $141,848. Note that these percentages are based on earnings, not debt balance, which could result in a higher tax owing to the ATO during tax lodgement. Now, self-employed individuals should account for this throughout the financial year. Is interest charged on this debt? Now, HECS or HELP debt is interest-free, but the debt is indexed to inflation each year to maintain its value. The debt can also be repaid voluntarily at any time without incurring any penalties. Although it is interest-free, inflation has been climbing quite rapidly, which means that indexation has also increased. On average, indexation has been less than 2%, but in 2022, indexation was 3.9%, and it could rise up to 7% for the financial year 2023, which could result in hundreds or thousands of dollars in extra repayments compounding over the years, especially if income is not growing at a fast enough rate or higher repayments are made. It's important to know indexation is applied on the 1st of June each year. Now, to pay or not to pay, that's the question. Here are 3 reasons why it might be smarter to pay down your HECS or HELP debt earlier. 1 is save money on inflation adjustments. Inflation adjustment is applied on the 1st of June each year. While HECS doesn't attract interest, it is indexed, as I mentioned earlier, according to inflation, meaning that the debt increases in line with inflation each year, effectively increasing the real value of the debt. By paying off your HECS debt earlier, you can save money on this inflation adjustment. 2, improve cash flow. Repaying your HECS debt earlier can free up cash flow in the long run. Once you have paid off your HECS debt, the repayments that were previously being deducted from your salary will no longer apply, leaving you with more money in your pocket each month. 3, improve credit rating. If you are looking to take a loan or a mortgage in the future, having a lower level of debt can improve your credit rating, making it easier for you to secure credit at a lower interest rate. If you are planning on paying down your debt, act fast because indexation is applied on the 1st of June each year. Here are 3 reasons why it might not be smart to pay off your HECS debt earlier. 1 is the opportunity cost. If you have the option to invest your money in assets that have the potential to generate a higher return than the inflation-adjusted HECS debt, such as stocks, property, it may be more financially beneficial to invest the money rather than paying off your HECS debt. 2, low interest rate. Historically, HECS debt is interest-free and the inflation adjustment is generally low, except these past few years, and this year inclusive. Therefore, you may be better off prioritizing the repayment of higher interest debt or investing your money in other assets that generate higher returns. 3 is loan forgiveness. Now, this is a complex one. There are certain circumstances in which HECS debts may be partially or fully forgiven, such as if the borrower dies or becomes permanently disabled. In these cases, paying off the HECS debt earlier may not provide any financial benefit. Now, in summary, HECS or HELP is a loan program provided by the Australian government to help students pay for higher education. It is indexed to inflation and repayment is income contingent. It may be smart to pay off HECS debt earlier to save money on inflation adjustments, improve cash flow, and improve credit rating. However, it may not be smart to pay off HECS debt earlier if there are higher returning investments opportunities, that the debt is interest free, or there is a chance of loan forgiveness. Thanks for watching this video today on HELP or HECS debt. Please consider subscribing to the YouTube channel Boring Money, where we'll be discussing things that are boring but can really help you out in the long run. Thank you. You stay safe.